Greetings, and welcome back to the Rose Bros podcast. This episode, we are joined by Brad Docherty, founder, chairman, president, and CEO of SourceRock Royalties, Canada's only junior publicly listed energy royalty company with about 75,000 gross acres of royalty lands and a market cap of approximately $30 million. Since 2014, SourceRock has grown consistently through acquisitions, paying approximately $13 million in dividends to shareholders with the use of no debt. Brad graduated from Mount Royal University with a Bachelor of Applied Justice Studies in Criminology and the University of Victoria with a Bachelor of Laws degree. Among other things, we sat down and discussed being Canada's only junior energy royalty company, the sweet spot for acquisitions, win-win deals, why royalties can be a tool in the capital structure, and how technology is unlocking new opportunities in energy. Enjoy. This podcast episode is sponsored by Connate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Connate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info at connatewater.com or check out connatewater.com for more details. This podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny-Osborne Paradis, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. All right, why don't we begin?
Yep.
Brad Docherty, good morning. Thank you very much for doing this.
Thanks for having me. Appreciate it.
For the listener, you are the CEO and president and founder of SourceRock Royalties.
That's correct. Yep.
What is SourceRock Royalties?
So SourceRock is a pure play oil and gas royalty company. Founded the company 10 years ago privately, and we've been building up a royalty portfolio across Saskatchewan and Alberta over the 10 years. And we listed the company on the TSX Venture Exchange in March 2022.
And originally you are a lawyer by training.
Yep, correct. I was a corporate securities lawyer by background and kind of birthed SourceRock kind of while I was practicing and working with various, small junior oil and gas companies and other junior companies in different industries, and, really saw the royalty business model as a way to create a scalable and sustainable business in the oil and gas sector, and saw it as a unique opportunity in Western Canada with a big sandbox of royalty opportunities and not many companies pursuing them, especially on the more junior side of the business.
Did you always want to be an entrepreneur?
Yeah, I think ultimately in my younger years I always wanted to be a lawyer, and I think through becoming a lawyer I was exposed to the entrepreneurial opportunities and mindsets of people much more experienced than me that were looking for corporate legal services. And I think through my legal background and exposure to public companies and private companies through my practice, I really kind of got that entrepreneurial itch kind of ingrained in me, and kind of learned a lot about, not only what to do, but what not to do when you're trying to become an entrepreneur and start a company. And I really kind of saw entrepreneurialism as something that can, have two very different paths, being, binary, where you succeed or fail, or taking kind of a slower, steadier approach that kind of I viewed the royalty business model as something that could, kind of progress over time and be sustainable and scalable.
Why start a royalty company?
Yeah. So, I think it ties into that want to do something that was scalable and sustainable and being able to, kind of continuously in the business model, control your cost structure and have, cash flow in the business. So, dating back to our very early years, we've never had a cash flow negative quarter in the history of the business, even out of the gate being very small. As a royalty company, there's not a lot of day-to-day costs that go into managing the business. And so we were able to, get off the ground in a small way 10 years ago and, buy our first initial, royalty asset, and then ultimately, be profitable kind of on day one. And then, really I saw the royalty space as something that was, under pursued in Western Canada. There's always been a few royalty companies out there, typically, much larger entities pursuing, larger transactions. Kind of viewed the royalty opportunity set as quite vast and being, something that there wasn't many junior companies or smaller groups focused on, and, kind of saw an opportunity to be a consolidator of smaller royalty opportunities, leveraging relationships that I had and through our group that we put together out of the gate, and to kind of build a royalty asset base that could be managed prudently day to day. And that could be, creating a sustainable business model to not only provide growth, but provide, a yield to shareholders on a steady basis.
There's a few royalty companies in the sandbox nowadays. Topaz, Freehold, shout out to Marty Staples at Topaz, big supporter of the podcast. But have you noticed the sandbox get a little busier over the years, or have you found that there is room for everyone to compete?
Yeah. So I definitely over the 10 years, there's been kind of, call it a change a few times. And I guess who's out there, right? When we started Source Rock, there was a couple of private groups doing it. Again, not small groups, but smaller compared to the only public company at the time being Freehold Royalties, who had been around a long time and had a great track record of building an amazing business. And ultimately, as time went on, obviously Prairie Sky became created.
Shout out to Prairie Sky, also a big supporter.
through Encana. And then, we've kind of seen almost, on the back of Topaz, we've seen kind of, again, a bit of a consolidation of the smaller guys happen. And, as we sit today, we're kind of the only junior pure play oil and gas royalty company in the public markets. And then you've got 3 very large entities out there. And so, we've always had the approach that, we're going to leverage our group's relationships to find royalties and structure royalties and create partnerships with smaller groups that are out there, or to, again, just find existing royalties through kind of our niche relationships, knowing that the bigger guys are out there, typically pursuing larger transactions that we couldn't execute on or compete on. So, we're really looking to be that kind of niche consolidator of the smaller royalty opportunities, and working through the smaller royalty partnerships that aren't going to move the needle for our larger peers. And we've kind of consistently completed royalty acquisitions over the course of 10 years and largely stayed away from marketed processes of royalty dispositions, and really kind of worked to, use our group's relationships and build partnerships and find acquisition opportunities that way.
The best entrepreneurs put their own money into a company, skin in the game. Did you have to put your own money into the company, get it going?
Yeah. So when we started the company in 2013, I went straight in with everybody else on day one. So there was never any founder shares issued in this company. And so I put hard dollars in on day one at the same cost as everybody else. I participated with hard dollars in every financing we did over the last 9 years as a private company, put more capital into the IPO, again, just kind of directly aligned with all the shareholders. And so, my average cost as the founder is actually higher than our current trading price in the market. And so, we've kind of built this very clean capital structure where us as insiders, founders, and large shareholders are very directly aligned with, our current shareholder group. And really kind of always wanted to make it a group process and a group ownership structure, as opposed to, having, cheap shares as founders and things like that, where we might be motivated differently than the rest of our shareholder group.
Just have your shares given to you.
Exactly. Yeah, exactly.
As a energy entrepreneur, that's a pretty rare breed nowadays. Energy entrepreneur at a small royalty company, that's ultra rare. Have you found it to be lonely at times? How do you deal with that kind of unique company? How do you explain it to people? Does it take much explaining?
Yeah. I mean, after 10 years, I'm still the only full-time employee in the business, and always had a part-time CFO. We had a CFO that was with us from inception until mid last year. And then we brought in a new CFO mid last year. And then she's been great to work with, great capital markets and oil and gas experience, in Western Canada. And then other than that, I think the network of people I have around me is kind of always there to kind of lean on and bounce ideas off of. And, we do have a fairly large board of directors who, I'm always, actively talking with, a great group of guys. Not only from a professional perspective, but from a personal perspective, they're great guys. And, so I get to lean on them and talk to them as much as I like to, choose to reach out. And then I think the really great thing for me though, is that, as I alluded to, we're always pursuing our own acquisition ideas and opportunities and trying to identify opportunities as opposed to just, bidding on things that are out there in the market. And so through that process over the last 10 years, I've certainly met a ton of awesome people. And, I think it's a constant process of going for coffees and lunches and having phone calls with people that I don't know or that I may have not ever met that have come to me through a relationship. And so I think it's actually, kind of somewhat of a blessing that you're not kind of just working with the same team of people all the time and only talking to the same group of people every day. I'm having to talk to new people every day and pursuing new opportunities and making new relationships and really trying to not only get the story out there from, a public company marketing experience, but, continuously getting the business model out there from the standpoint of, being a potential partner for the industry as a source of capital. And in particular, on the junior oil and gas producer side, we're continuously trying to find new relationships and partnerships to work with to, try to be there as a capital partner and fit ourselves into the conversation and around the capital stack between, debt and equity, and how does royalty capital play into that?
On the other hand, being the only or one of the few junior energy royalty companies probably creates opportunities too, because there's not many of you.
Yeah, exactly. And as I mentioned earlier, I mean, our larger peers are obviously very, very successful, amazingly positioned businesses, and they need to do typically larger transactions to, move the needle in their business. And so, my perception of their strategies just, through, reading their public disclosures is that, they're looking for high quality opportunities and are size agnostic. But I mean, ultimately, day to day, I would envision that they're out there looking for, more material size transactions than what we could execute on. And so, we do, kind of continue to see a niche opportunity for a company our size to acquire smaller royalties and to, be a source of capital to junior producers and, that are either not finding that debt's available on the terms they want, or that, equity valuations are too low for what they would be willing to issue, shares at, or the equity is just not available. And so, I think that, the size of transactions that we're looking to pursue definitely kind of creates an opportunity, given that, we're one of the only few groups out there looking to pursue those size transactions on kind of a day-to-day basis.
What to you is a good royalty?
Well, we've maintained a very strong light oil focus over the years, and that will continue to be kind of a core mandate for us going forward, and kind of expanding that into oil in general, and trying to stay as an oil focused royalty company. So that is kind of characteristic number one, just from the commodity exposure side. But I think for us, we're always kind of looking at things from kind of a portfolio approach mindset. We don't want something that's super high risk, even though it might be high reward. But we also don't want something that's just kind of sideways to down over time. And so we're kind of always looking to find royalties that have both, existing production, kind of proven reserves with strong geology associated with them, but at the same time giving us exposure to ongoing drilling locations. So again, ultimately oil-focused royalties are our preference. Royalties with existing production, identifiable upside drilling, and a counterparty that's able to execute on that upside drilling would be kind of the primary things that we're looking for.
You can buy existing contractual royalties, free title or crown land, or you can manufacture royalties by participating in drilling. Do you have a preference on the kind of avenue you like to go down?
Yeah, it's been an evolving strategy over the years. I mean, when we started the company in 2013, our focus was on existing royalties and looking to, find, just individuals that owned royalties out there that were looking for liquidity for that royalty interest. But, we've really found over the 10 years with oil dropping 3 or 4 times materially, the opportunity set to, as you mentioned, has really kind of expanded on the more manufactured royalty side where you're working with an operator. And so, we're kind of finding right now that those are our most constructive, best conversations that kind of fit the characteristics that we're looking for, being, getting exposure to that existing production and ongoing upside drilling opportunity. The challenge with the portfolio of royalties for us, obviously they could be very attractive from a geological perspective, but you don't really have a relationship with that operator from the standpoint of knowing what they're going to do on the lands and knowing if or when they're going to drill future wells. And so, we kind of are obviously always looking at opportunities on existing royalties, but really kind of spending most of our effort on trying to create more and new partnerships with smaller operators that, have assets already or are looking to acquire new assets that have kind of, again, proven reserves on the lands and identifiable upside opportunity on the drilling side that, we can kind of get that comfort from them through the royalty transaction structure or just through the relationship that, they're going to continue to develop those assets and create growth in them.
On existing royalties, the returns are steady and predictable. The returns might not be quite as high, though, because everybody knows the value. You can predict it and cash flow it out. The real value is on the upside from undiscovered opportunities. Do you proportion out your budget on how you want to allocate your capital to the various styles of royalties, or how do you think of it that way?
Yeah, I mean, no kind of specific mandate in terms of percentages, but I mean, I think we're ultimately always trying to balance that existing production, proven reserve exposure wedge alongside getting, ongoing exposure to upside drilling opportunity. So, I think everything's opportunity by opportunity basis. And I think with the upside exposure side of it comes other elements to evaluate in terms of, the ability of the counterparty to execute on that and, how strong is the geology. So, I think we're certainly never going to kind of go all in, so to speak, on upside exposure. I don't think that bodes well with a yield business model. So, ultimately we are kind of always trying to balance those two factors. By that, I don't mean necessarily 50-50. I just mean kind of balancing, the growth of the proven reserve existing production wedge alongside, getting some attractive exposure to, ongoing development and undeveloped drill locations on the land. So, more of a general approach to, again, trying to maintain that balance between, again, proven production growth and kind of upside exposure opportunities.
Now, the way royalty companies compete is in the cost of capital, but a lot of times you ask somebody what their discount rate is and they don't know, or they'll give you 10%. When you're thinking about your discount rate, how do you think of it? Is it the risk-free rate? Is it higher, 15, 20%? Do you have a kind of a number you like to go off of or a rule of thumb?
Yeah, in terms of evaluating opportunities, I would say every opportunity is different because of that dynamic that we just talked about, right? How much upside exposure is there and what's the potential for it to get developed. For us, in terms of evaluating our own internal value, we're kind of at the whim of the cash flow multiples in the market most of the time. We find that that's what most counterparties want to talk about in terms of, how is our business being valued. From a reserve perspective, obviously we get a reserve report like the other royalty guys do. And that process is a bit different for a royalty co than an E&P. And so, we're kind of always looking at that as kind of a backstop for the business, not too focused on exactly what discount rate is applied to those assigned reserves simply because, we're not getting as fulsome of a report done as an E&P would because we're not the one controlling the development of the land. So, for us, we're much more focused on kind of modeling out production internally, obviously using the reserve report as a backstop on, what an independent party sees as upside opportunity in our lands.
The cost of capital is rising with interest rates going up to reduce inflation. One great thing about royalties is they're at inflation hedge. Does that make it easier to sell the story these days to investors who are looking for protection against inflation?
Yeah, it's definitely a component of the conversation. The fact that there's no ongoing capex or any costs associated with, with the activity on our lands or the future liabilities on our lands. That's definitely been an attractive conversation point for potential investors. I think we're finding that, most conversations we have, they're quite focused on the yield and the sustainability of the yield and the track record in paying the yield. Obviously in a rising interest rate environment, there's very low risk yields out there that are, becoming more and more attractive. And so I think we're kind of finding the investment community is looking for higher yields than a risk-free yield. And then trying to gauge the risk associated with that higher yield and understand the sustainability of it in kind of obviously an ever-changing energy landscape. And so, I think that, the inflation protection is definitely an attractive component of the business. We obviously get a lot of positive feedback around, just having low costs and being able to kind of drive, profitability on a per barrel basis. Given we're, managing things as a royalty company does with kind of, low day-to-day costs. And I think sustainability of the yield, alongside the inflation protection is definitely something that investors are intrigued by.
But the company has no debt, so that's a great thing for SourceRock is that you don't have to raise a bunch of money or you haven't needed to yet, which is good.
Yeah. And so, we raised just under 13 million of net proceeds in March 2022 when we listed and went on the venture exchange. Obviously, we had raised money privately in multiple tranches over the 9 years before that and deployed all of that capital on royalty acquisitions. So then when we went public in March 2022, we'd raised the money to kind of call it aggressively pursue acquisitions and growth. And, we very quickly found ourselves in a very, very high oil price environment and really kind of paused and slowed down in terms of how aggressively we were looking to pursue that capital, trying to be, prudent and disciplined in rolling that out. So, we are still, sitting on about 13 million of cash, or working capital to deploy on acquisitions. And, we completed a small acquisition, $3.5 million in November of 2022, which is our first transaction as a publicly listed company, actively looking to deploy the remainder of that capital and, looking to again, scale that royalty asset portfolio, both from an existing production standpoint and, upside exposure standpoint.
Like we were saying, the royalty sandbox has a few more players in it nowadays, although you are one of the smaller ones. The best way to purchase assets is let them come to you, but it's hard to sit forever. Have you found a better strategy or a preferred strategy to acquire royalties? Is it just letting the phone ring, or is it processes, or is it geology, or do you have an avenue that you like to go down?
Yeah, definitely not sitting waiting for the phone to ring. That does happen a bit over, given 10 years of kind of being out there and looking to be an acquirer of smaller royalties. We definitely do get those inbounds from time to time, but our focus is really more kind of trying to generate our own ideas, be it with which counterparties are out there that, we think would be a good partner for us, or kind of leaning on relationships in different parts of the basin to try to find existing royalties in those parts of the basin. And then really kind of also trying to be, tapped into what's going on in the A&D environment and trying to see if we can kind of align ourselves with some of those acquisition efforts. If there could be a funding shortfall for the buyer, and looking to kind of, propose royalty capital from a group like us as a potential solution to getting that acquisition across the finish line. In
the spring of 2020, were you sensing opportunity? Oil went to zero. Were you excited that day?
Yeah, definitely a hard time for the industry, even a royalty co. You're obviously at the whim of the price environment. We experienced that, being light oil, the taps were turned off within, 4 or 5 days across, 75% of our lands. And we had about 75% of our production shut in quite quickly when the oil price crash happened. And obviously most of that came back on quite quickly, but it was certainly a dramatic time. We were still able in Q2 2020 to be cash flow positive that quarter with 75% of our production shut in and oil, at zero for a moment and in the teens for most of that time. So, obviously I think that kind of shows the resilience of the business model, and that despite that, we were able to kind of, quickly adapt and, adjust the little bit of cost that we did have to run the business and maintain, a cash flow positive quarter despite the carnage.
I think as Warren Buffett would say, when the economic clouds are dark, it briefly rains gold. Experienced that during that time? There were opportunities that came up that you look back on or you did take advantage of?
I think I would say not so much, because, you're kind of looking as a royalty co to, have that balance of risk reward from my perspective. And so, in a setting where there's going to be no activity on lands because oil prices are so low, it's hard to kind of see through that as an opportunity in the moment. And ultimately, you're kind of looking to value things at the oil price of the time. But at that moment, there wasn't really counterparties that were willing to say, well, we would do transactions at, $15 oil or whatever it was, exactly on the day. But, I think the bigger component of that is, existing royalty owners would have said, well, my check just got cut by X%. I don't want to sell now. Counterparties that we might be looking to have done a royalty transaction with, they wouldn't be able to sit there and say to us, well, we're going to develop this asset, successfully over the next 12 to 24 months because the market was so broken at that point. So, I think when things get that negative, we find that as a challenging time to do transactions. And we've certainly had the most success kind of in a middle ground type market where, if it's too negative, transactions aren't easily completed. If it's too positive, transactions aren't easily completed. And really it's kind of the middle ground, let's call it $50 to $80 WTI, where we're finding that, activity is good on lands. Counterparties are willing to, commit to activity on a go forward basis. Revenue's still strong for the business. A&D markets, are more active than when pricing's really high or pricing's really low. And so we've kind of really always found that that's been our sweet spot for transacting is between that $50 to $80 WTI price point. And it really just kind of allows a balanced conversation with either an existing royalty owner or, an operator that you're looking to structure a royalty with.
On the flip side, like you said, when oil is at $100, it's great for cash flow and everyone's happy, but it makes life difficult for you in the sense of acquisitions. Do you have to kind of sit back and remind yourself that although $100 oil is nice, maybe it's not the best time to be doing deals?
Yeah, no, absolutely. And, obviously we found ourselves in that spot last summer, having just raised a bunch of capital to do deals with. And we obviously were benefiting from it on the revenue and drilling activity side on our existing lands. But we definitely kind of had to pause and slow down our desire to deploy the capital we had just raised. And, I think certainly not that you can't get deals done in that price environment. Ultimately, if activity is going to be robust to the extent that you can see that value creation happen on the lands, regardless of the oil price, I think we're always hesitant when things get too frothy that that's probably not the best time to be rolling out the capital. But, again, I think we're kind of always looking and always pursuing opportunities regardless of the price environment. And $100 WTI, especially with the FX component, playing in, making that, $125, $130 Canadian, depending on the oil grade. I mean, that is a pretty tough Canadian realized price environment to be negotiating deals in. And, again, we like to transact in kind of the market we're in right now. That kind of 50 to 80 or even expanded, 70 to 90 is even a pretty nice spot where, you can kind of, structure win-win deals, right? With counterparties. And we're still largely in a market where valuations on the E&P side are quite weak. Historically speaking, and, debt for the junior part of the industry is still largely challenged, in terms of accessing it. And so, we're kind of really constructive of royalty capital kind of having gained traction over the years. Obviously our larger peers have done quite material transactions in terms of creating royalties with very, very well positioned, successful E&P companies. And I think there's very more openness to just fitting royalty capital into the capital stack, between debt and equity and viewing it as a tool as opposed to viewing it as, kind of a burden or something that's trying to be done to, as a last ditch resort. I think royalty capital has definitely become more positively received, not only in kind of through our dialogues and through, our transactions we've done with smaller entities, but also, through our larger peers really kind of doing these strong deals with strong counterparties on strong assets and really kind of, helping shine a light on the positivity around royalty capital being, almost partnership capital that's passive. The deals are set up where, an E&P company is effectively selling a piece of their asset in the form of a royalty and doing so at a metric that's accretive to their equity valuation. And it ultimately doesn't come with the parameters and handcuffs of debt.
How important do you think it is to do win-win deals where both parties are happy with the result?
Yeah, I mean, I typically say, especially in the manufactured royalty side, that if we're winning a deal, we're probably losing on the back end. I think ultimately we need to be structuring deals with strong counterparties that are looking to utilize royalty capital as a way to advance the asset. And then, we're going to benefit from the advancement of that asset. Again, if we're getting some terms on royalty transactions that we think are, so great that we're somehow ahead on that deal, then we must be missing something, or, we're taking on counterparty risk in that structured deal. And so we truly are, as cliche as it sounds, we truly are trying to structure win-win deals with well-positioned junior companies that are looking to utilize royalty capital to advance their business, or, advance drilling, advance acquisition strategies, fit ourselves into the capital stack with debt and equity, and not be, the solution or the financial solution for that company. I think it ultimately, royalty owners are pretty savvy customers. And so, I think, you're not going to go, typically, generally speaking, go find, an amazing gem of an existing royalty interest that you buy on some extremely cheap metric. And so, if you are buying something on an extremely cheap metric, it probably isn't as good as you think it is, because, again, there's a certain value to royalties, being that, you don't have to continue to put capital into the asset. And so, existing royalty owners are generally smart enough to know that. And, they're going to be expecting to get fair value. And so, that is always our goal, is, let's purchase royalties on fair metrics that make sense in the context of the market. Let's structure our royalty deals in a way that, is a win-win, positions the counterparty to do well going forward, because we will benefit from them doing well and successfully developing that asset.
SourceRock has no debt, like we said, and a decent amount of money in the bank. Have you found it difficult to find patient investors, or was it a niche investor that found you that provides the patient capital? Is there a tension there with shareholders, or how does that relationship work?
No, I think, again, we raised the capital early 2022, prior to the big spike in oil. And so, I think that by the time we got the capital, though, oil had taken off on us, and we kind of had to slow down on our acquisition ambitions. But ultimately, I think we've kind of received positive feedback so far in that, we didn't deploy all the capital in, the summer pricing environment, which was clearly a recent top, and ultimately we've kind of waited here and deployed a decent amount of it late last year in a better price environment, and continue to look to deploy the rest of that capital. So I think our shareholder base is certainly patient, because the dividend that we pay is something that we've paid for a long time. We started paying the dividend in Q1 2014, and we only paused that for 2 quarters during COVID. Continue to, have a low payout ratio on that dividend based on our existing assets only. Ultimately our acquisition activities and efforts continue. And I think that's the key, is that, our shareholder base continues to ask us, do you continue to see opportunities? And I think that, obviously we do. And we continue to see an ability to kind of be there as a source of capital to the junior side of the market, and also continue to find new existing royalties to look at. And so, ultimately, our capital deployment rollout is still active and looking to be executed on. And in the meantime, our shareholders are getting a strong yield north of 8% on our current share price. That dividend's well covered based on our existing assets only. And, with interest rates rising, we've continued to, kind of, I guess, get paid to wait, so to speak, on our cash. And ultimately that, kind of zero risk interest rate has gone up so much that we're actually getting a monthly check, on our cash balance as well, which kind of helps to cover the few costs that we do have to run the business, and allows us to continue to be patient. Because again, we're not in a position where we need to force the capital out to, cover the dividend or cover costs associated with the business. So I think the shareholder base is really more concerned about us getting the right transactions done, and doing so at valuations and metrics that make sense, as opposed to, just getting the capital deployed for the sake of getting it deployed.
With the recent pressure on the energy sector, a lot of people have left the sector in terms of investment. Have you found it difficult to find investors for the company?
Yeah, I think there's definitely been, a shorter list of kind of, call it, institutional investors supporting junior oil and gas companies, for sure. So, our capital raising strategy was really kind of more focused on going broad, both retail and small kind of institutional investors. And so, we did manage to get, kind of 8 small institutions involved in the IPO. And ultimately, then we had a very broad kind of retail, high net worth retail investment component to our IPO. And we've continued to find that, post IPO marketing has been largely focused on, call it that high net worth retail pockets of capital that are looking for yield, looking for something that, has that kind of inflation protection, no ongoing CapEx kind of aspect to its business. And so, we definitely don't have kind of a long list of funds that we would go talk to about our business model, being that it's kind of a 32 million market cap, 20 million enterprise value type entity. But we've certainly, got lots of positive feedback at retail investor conferences that we've attended. Again, call it, retail marketing that we've done, again, focused on groups that are looking for yield, looking for lower risk platforms from the standpoint of, not having large capital expenditure programs that, may need to get funded somehow. And just, those kind of investors that are looking for a low cost platform that has a track record of not only paying that yield, but a track record of sustainability and cash flow. And so, so certainly more of a retail focus in terms of where we've been presenting the story, but ultimately, always kind of poking around to try to find that, call it kind of smaller institutional capital, that's out there looking for, exposure to royalties, which ultimately, again, as we've talked about, there aren't a lot of opportunities in Canada to invest in public entities. I think obviously the three larger companies that we've talked about are obviously all amazing investment opportunities. We're just a different form of that. And again, pursuing kind of a different, sized acquisition strategy. And so, ultimately, again, we're trying to really kind of position ourselves as just an option to the royalty investment model in Canada, that it's been well received.
With interest rates going up, it presents an opportunity for Source Rock as an inflation hedge. But on the other hand, do you worry that rates will go up too much and that it'll match your dividend rate? Does that worry you?
Yeah, I mean, I think that it does feel like the market yields are kind of tracking with interest rates going up, which is logical. And so, I certainly wouldn't want to see interest rates 7, 8, 9, 10% for more reasons than just related to Source Rock. But I think, relating to Source Rock, or the market, the oil and gas sector more generally, I think that we would probably continue to see that kind of logical push for, yields would go higher in our sector if interest rates continue to go higher. Otherwise, because capital will just flow out of the industry and flow into, call it zero risk product that's providing that higher yield. There'll be some components of the investment community that are looking for the growth equity capital appreciation side of it as well. But, I think we're naive to think that there's not also a segment of the investment community in oil and gas that is just in it for the yield at this point. So, I wouldn't say worry is the word, but I think it's always something that, you need to be cognizant of. You may continue to see valuations go down because yields are needing to go up. So hopefully we're, through the majority of the interest rate rise, but, obviously, none of us have that crystal ball. And I think, we'll kind of always just be cognizant of it and, trying to adapt to it from the standpoint of, ensuring that the investment opportunity and the, the yield component of our business as part of the investment opportunity is being presented and managed in a way that aligns with, call it the lower risk interest rate side of the market, because I think they are, not specifically tied together, but I think you can kind of see that as interest rates rose late last year, yields in the oil and gas sector went up through equity valuations going down for the most part. And so, ultimately, we're certainly cognizant of that.
In terms of risk, how do you define risk at a royalty company? What keeps you up at night?
Yeah, I mean, I think the risk for our business model is, activity slowing for sure on our lands and across the industry in general. Really kind of underperformance of the assets would be kind of, something that is going to be kind of the key negative that could happen for a royalty company, call it from an existing asset standpoint. And so, that is kind of always in the back of our mind from an acquisition strategy standpoint, is that, we need to be continuously diversifying our asset base, trying to build up that existing production profile, while at the same time getting, diversified exposure to upside opportunity. And so, I think for, royalty models are obviously insulated from a risk standpoint in that, we're not deploying a bunch of capital on a well that could be worth nothing and we lose all that capital. But ultimately, your acquisition strategy needs to account for the fact that payouts on royalty deals are typically a bit longer than someone who's drilling a well. And so, there's lots of variables that go into that. And so, we're always, again, trying to manage the risk in our business by diversifying our asset base and continually expanding, again, that production profile and the upside exposure so that we're not kind of counting on one particular asset to, make or break the go forward of the business.
One risk investors face is that when you determine a payout, it's too long. You don't get your money back in time. How do you think of it that way? Do you have a kind of rule of thumb you like to go for in terms of years, or how do you think of your payout timelines?
Yeah, every acquisition is different for sure, right? It's going to be completely dependent on the risk associated with that payout. And for us, if something is a, kind of a slow, steady, long life proven reserve asset that has a low decline, well, you're going to probably pay less for that, but have more certainty around your payout. Something that has a much higher growth component to it, it may look like a higher payout a longer payout on day one. That's going to be driven down by, the activity that's happening in the land, on the lands through the structure. And so for us, I think rule of thumb is probably not something that we would have in our back pocket. It's more trying to, have a shorter payout on things that have less growth and be willing to accept a longer payout on opportunities that have growth, but trying to, I guess, de-risk what will that payout actually be, given it needs to be affected by ongoing drilling activity. And so we're obviously continuously kind of at the whim of the cash flow multiple ascribed to our business in the market. But at the same time, we're usually trying to look at acquisition opportunities on a case by case basis and recognize that, every acquisition opportunity is going to have different characteristics that may not be exactly the same characteristics as our existing asset portfolio. And, really trying to, again, manage the risk associated with upside execution, but ultimately we don't want to shy away from getting exposure to material growth just because there's some risk that the payout may be a bit longer, because ultimately, that growth component of the business is important, just as building out the proved reserve existing production component of the business is important.
One of the criticisms of Canadian energy is that the basin is mature and there's not many big plays to be found anymore. But then on the other hand, once in a while, a play like the Clearwater comes along. Do you get any flyers in the back of your head that you think may end up like the Clearwater? How do you keep a list of plays that you think have potential, or how do you think of maybe the next up and coming play?
Yeah, I think, what we're finding is that through all of our different dialogues, we're kind of hearing a lot about what's happening out there more on the kind of the new technology side and not necessarily new discovery side, because those are often kept quite tight to the chests of the E&P groups out there. But I think what we're finding is that there's a lot of revisiting of past areas and plays that haven't received the new technology that's happening, both in the Clearwater and, even East Central Alberta more generally. I think you're seeing a lot of these technologies get applied over into that region as well. And, now you're seeing new technologies applied, into the Bakken and Southeast Saskatchewan and having kind of a reinvigoration of success down there in small ways. And so, I think for us, we're kind of constantly through our dialogues trying to find out what some of these groups are doing. Obviously we're not talking to, large E&P companies that, kind of have these groups internally that, are kind of working up different plays in different ways. But, there's a lot of smaller groups out there that are trying, testing new concepts, revisiting, old plays with new technology. And, and I think that, ultimately that is an attractive opportunity for us because it's ultimately a known resource that is, now being, extracted in a more technologically advanced way, as opposed to a new play that might bring different risks. Although there may be obviously, higher reward to that in the sense that, if a new Clearwater was discovered and you were exposed to it, that would be massive. But ultimately, that often comes with a lot of upfront capital that's quite high risk capital. And so, for us, we're kind of, again, trying to stay tapped into what areas are kind of getting reinvigorated through some of these new drilling technologies and drilling approaches that have, kind of evolved over the last couple of years. And, I think it seems like there's a few pockets of that happening on the oil side, across Alberta and Saskatchewan, and some interesting, smaller groups that are testing new drilling approaches and getting a lot of success out of it.
The analogy Neil Roselle from Headwater made when I talked to him was that you want to be the third owner of a golf course where the first couple go bankrupt, but usually the third owner gets it right. So perhaps it's that kind of strategy when you're looking at assets.
Yeah, for sure. Right. I mean, like we've always kind of tried to take the approach that, we don't need to be the first guy in the room and the first guy at the party. And, ultimately we've kind of we've done various transactions across Alberta and Saskatchewan focused on oilier parts of the basin. And, those have generally been at the point where the geology is known, kind of an activity spike happening or expected to happen. And, we've kind of early days of Source Rock, we saw that in the Viking in West Central Saskatchewan and did a few transactions there. And then over the last few years, we've really kind of exposed ourselves heavily to the Frobisher in Southeast Saskatchewan, as again, success has been happening down there, and lots of smaller groups, having a lot of success and focused on very geologically driven parts of the region. And it's not a blanket resource play in that sense, but ultimately there's definitely geological expertise happening down there that's driving the kind of newfound growth of the Frobisher in particular. And so we don't tell ourselves, well, you got to go buy a bunch of land and be the first guy in and then find someone to drill that land. We've typically tried to more align ourselves with groups that we're seeing have initial success and then ultimately present ourselves as a capital option to kind of help accelerate that success and that activity that they're undertaking.
Do you think there's a lot of those twice bankrupt style plays out there? Are there many that are ready for the third owner? Are there?
Yeah, I mean, not particular to, assets that have failed. No, I mean, I think, we're trying to be more focused on areas that are having success versus areas that have failed. Certainly we wouldn't shy away from conversations around, proven groups that are looking to acquire kind of underloved assets that, have been orphaned by failed company or, a larger company that it's just non-core to them. I think our focus is more, where is success happening? Where is activity consistent? Or how do we get ourselves exposure to those regions as opposed to, trying to find something orphaned and hope that it revives itself?
One of the ways that investors outperform the market is you have to be unconventional but right. Because if you just follow the market, you'll get average returns. Have you thought of it that way in terms of finding royalties and kind of, like you said, going the other way and going for things that are unloved or finding plays that haven't got the attention? Or how do you think of it that way?
Yeah, I mean, I think for us, again, being kind of play agnostic at general but oil focused, I think we're really more trying to position ourselves with groups as opposed to in specific plays. And so, we're almost unconventional by nature, given that we're such a small entity kind of undertaking this business model relative to the much larger entities. And so, I think that, our smaller counterparty set and our approach to smaller transactions, kind of does create, a bit of an opportunity in the sense that, again, we're not having to go, find the much larger transaction to move the needle. We can kind of, be nimble and do small deals that may present, a potential higher kind of rate of return, given that, they're not being pursued by, a larger swath of potential buyers. And so, again, I think, for us, the strategy of leveraging kind of our relationships to pursue smaller deals and kind of trying to, again, not be focused on something having to be of a certain size. I mean, I think that really kind of presents an opportunity for us to continue to kind of, again, consolidate those smaller royalties that aren't being pursued by many or no other peers.
Well, that's a lot of questions. That's a great conversation. If you were to leave the listeners with a message for more investors looking to potentially invest in Source Rock, what would you tell them?
Yeah. So again, we're uniquely positioned in the market as the only junior oil and gas royalty company in the public markets in Canada. And, we've got a 10-year track record of deploying capital on royalties, being oil focused, 10-year track record of being cash flow positive. We've got the highest yield in the royalty co space. We've got the lowest valuation in the royalty co space. We have the highest net back per barrel, being that we're, light oil focused. We're positioned with just under 30 cents of cash per share, which is, about 40% of our market cap, which really kind of allows us to create growth through acquisition kind of near term as we continue to work towards more deals. And I think as we talked about earlier, we got a very vested and aligned group of founders and shareholders. We've got this long track record of providing a yield to shareholders, which will continue to be a core component of our business model. But, really we do want to kind of be a balanced growth and yield business model and be continuously expanding our core production profile and also continuing to expose shareholders to ongoing upside opportunity, and feel like we're uniquely positioned to do so.
Well, thank you. I really appreciate your time.
Thank you. Thanks for having me.
We'll wrap it up there. Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.